The euro finally broke out of recent range last week and ended as the strongest currency on improvement in the banking system as well as overall confidence. On the other hand, the Canadian dollar was the weakest currency following the Bank of Canada's statement that dented any hope for a rate hike, and deeper selling was seen after a tame inflation reading. The Aussie and sterling were both weighed down by disappointing economic data, and in spite of strong risk appetite as seen in rally in stock markets, Canadian dollar, Australian dollar and British pound were not supported. Some recovery was seen in the Japanese yen after the Bank of Japan meeting as markets were disappointed, but sell-off quickly resumed and sent US dollar, Japanese yen and euro yen through the 90 and 120 psychological levels respectively. In the US, the House of Representatives approved the bill to suspend the borrowing limit by a 285 to 144 vote, lifting the government's borrowing limit of $16.4 trillion until May 19. IMF Chief Lagarde warned that U.S. officials have to consider the leading role played by the U.S. economy in the world is at stake. And she urged Congress to settle the debt ceiling issue as soon as possible rather than kick the can down the road a little bit longer for a little bit farther. Lagarde said that, if they take the time to really sit down, rationally and sensibly putting a little bit of their respective ideology on the side to really focus on what is good for the economy and what is going to be good for the rest of the world, that's great. In the Eurozone, the news that boosted euro-dollar out from recent range was the European Central Bank saying on Friday that 278 banks would repay €137.2 billion, or 30% of the long-term refinancing operation loan on January 30. That's significantly higher than markets' expectation of around €100 billion and was seen as a sign of better than expected improvements in the long-troubled Eurozone banking sector. In addition, economic data also supported the euro. The German ifo Business Climate Index rose for the third month to 104.2 in January, up from 102.4 in December. Also, that's the highest level since last June and beat expectation of 103. The current assessment rose to 108 while the expectation gauge rose to 100.5. Both beat market expectations. German ZEW economic sentiment rose from 6.9 to 31.5 in January versus expectation of 12. That's also the highest level since May 2010. The current situation gauge also improved from 5.7 to 7.1 versus consensus or 6.2. Eurozone ZEW economic sentiment also jumped sharply from 7.6 to 31.2 versus consensus of 12.2. Eurozone PMI indices improved more than expected in January even though they're still staying in a contraction region. Manufacturing PMI rose from 46.1 to 47.5 versus consensus of 46.6. Services PMI rose from 47.8 to 48.3 versus consensus of 48. German PMI manufacturing rose from 46 to 48.8 versus expectation of 46.8, while services PMI jumped sharply from 52 to 55.3 versus expectation of 52. French PMI indices disappointed though and deteriorated. Sterling was sold off sharply against the euro as Q4 GDP disappointed. The UK economy contracted by 0.3% quarter-on-quarter in Q4, compared to expectation of 0.1% contraction quarter-on-quarter and 0.9% growth in Q3. The data showed some evidence of fallback from the boost by the Olympic Games in Q3. And it raised concern that the UK is heading into a triple-dip recession. UK Treasury said that the figures reflect that Britain, like many European countries, faces a very difficult economic situation. Chancellor of the Exchequer Osborne said that the problems the UK is facing were many years in the making and there's no magic solution, and it takes hard work and perseverance to bring a lasting recovery. Bank of England minutes unveiled that policymakers voted unanimously to leave the bank rate unchanged at 0.5% and 8-1 to leave the bond purchase plan unchanged at £375 billion. David Miles favoured expanding the stimulus amid concerns that the rise of the pound would be detrimental to economic growth. The majority of the Monetary Policy Committee members believed that economic developments in December were modestly positive and it was not necessary to cut interest rates further or increase the size of bond purchases at that moment. After its rate-setting meeting, the Bank of Japan doubled its inflation target to 2% at the January meeting, although this decision was opposed to by 2 members. Meanwhile, the central bank left the uncollateralized overnight call rate unchanged at 0 to 0.1%. The Bank of Japan also surprised the market by introducing an open-ended purchase program. After the current asset purchase program, the central bank would purchase a certain amount of financial assets each month without setting a completion date. Yet, the market appeared dissatisfied that the program would commence only in January 2014. The market had anticipated it would extend the current asset buying program. A key fact to consider is that Bank of Japan Governor Shirakawa is going to end his term in April. Prime Minister Shinzo Abe is expected to choose a policy dove to succeed Shirakawa and help him implement his Abenomics. Hence, even though the yen attempted to recover, it was only brief and the uptrend in US dollar, Japanese yen and euro yen quickly resumed after Deputy Economy Minister Yasutoshi Nishimura said that dollar yen's current level at around 90 can be said to be a correction of the strong yen, but it isn't over yet. Also, Nishimura said that a level of 110 to 120 might be a concern as that would raise import costs. Markets took that as an indication that dollar yen at 100 wouldn't be a problem. The yen was also weighed down by inflation data and December Bank of Japan meeting minutes. National CPI core dipped 0.2% year-on-year in December, down from November's 0.1% year-on-year. The reading stayed negative in 7 out of the past 8 months with only a 0% reading back in October. The details were even more worrying as persistent deflation pressure was seen in almost every category, with a dual core measure, which excludes fresh food and energy, down 0.6% year-on-year. The data raised expectation that firstly the bank needs to raise its easing effort and a 2014 plan on open-ended asset purchase is simply not strong enough. Secondly, political pressure on aggressive central bank easing will certainly be increased in the months ahead. Meanwhile, the December meeting minutes showed that a few board members noted that it was necessary for the central bank to demonstrate its aim to encourage a further decline in short-term interest rates, thereby narrowing or reversing interest rate differentials between Japan and other economies, with a view to exerting influence on foreign exchange rates. And, the members also expressed that purchases of treasury bills should be increased substantially, with one member noting that the Bank of Japan should also considering additional purchases of Japanese government bonds during the further half of 2013. There was even a member who proposed lowering the interest paid on excess reserves from 0.1% to 0% and cutting the fixed rate fund rate from 0.1% to 0.03%, but that was voted down by other 8 members. The Canadian dollar was sold off sharply after the Bank of Canada left its key rate unchanged at 1% as expected. Correspondingly, the bank rate stayed at 1.25% and the deposit rate at 0.75%. More importantly, the central bank also revised lower its GDP forecast to 2% in 2013, down from a previous estimate of 2.3%. The economy will reach full capacity in the second half of 2014 with GDP accelerating to 2.7% by the end of that year. Inflation is expected to average at 0.9% in the first quarter of 2013 and stay below 2% until the third quarter of 2014. The Bank of Canada forecast inflation would be at 2% by the fourth quarter of 2013. The Canadian dollar dived after the report as the central bank saw less urgency for an interest rate hike. The loonie suffered additional pressure as CPI unexpectedly dropped 0.6% month-on-month in December and was unchanged at 0.8% year-on-year. That compared to expectation of an acceleration to 1.2% year-on-year. Core CPI dropped 0.1% month-on-month and slowed to 1.1% year-on-year. That's even worse compared to expectation of an acceleration from 1.2% to 1.4% year-on-year. The data affirmed the case that a need for rate hike is less imminent, and without existence of inflation pressure, the Bank of Canada will very likely stay unchanged for more time. The Aussie was also weighed down as CPI rose 0.2% quarter-on-quarter and 2.2% year-on-year in Q4 versus expectation of 0.4% quarter-on-quarter and 2.4% year-on-year. Treasurer Wayne Swan said the CPI result was further evidence that there has been no significant broad-based increase in consumer prices as a result of the carbon price. The data should give the Reserve Bank of Australia room for a further rate cut if necessary. So far, interest rate swaps are pricing in less than a 50% chance for the Reserve Bank to cut another 25 base points to a record low of 2.75% in February. But after all, another 25 base point cut is still generally expected within the next 12 months. The IMF lowered its global economic forecast. The world lender forecast that world GDP would expand 3.5% in 2013 and then 4.1% in 2014. These were below October's estimates of 3.6% and 4.6% respectively. In the Eurozone, the IMF estimated that the economy would contract 0.2%, down from previous estimate of 0.2% growth. For the US, growth would ease to 2% this year from the 2.1% estimated previously. Chinese economy would grow 8.2% in both 2013 and 2014.